It's our intention to let inflation run hot. Think about that. Think about that in the context of what's happened this year. Think about how much of inflation was juiced up by having ultra low borrowing costs, throughout COVID, by putting taxpayer money on the hook to buy government debt in order to fuel the surge in demand that we saw. Think about how many Canadians are now feeling the world of pain because they followed the guidance of interest rates staying low well into 2023. They followed the encouragement to go out and make major purchases, to buy cars, to buy homes. And now they're feeling the brunt as a second policy mistake is being used to try and fix the first, which is keeping rates too low for too long. Now we're seeing interest rates. We're seeing this year, interest rates going too high, too fast. It's hard to imagine a 50 basis point hike being good news, but perversely it is. That's how much the Bank of Canada raised rates this morning, 0.5%. I mean, consensus was for 0.75%, so a surprise to the downside for the first time since, January of this year. Coming into this meeting, there is still 1 to 1.25% in additional hikes being priced in. So we'll see if that now gets tempered down. What tends to happen is central banks will slow the pace of raising, which is hopefully what we started to see today. They'll pause, and then rates will come back down. So we're not out of the woods yet, but today was certainly a positive move for getting some eventual rate relief. This central bank, it's been such a difficult one to read and to navigate. For their entire tenure, it's been, extremely dovish, favoring lower interest rates, and then basically flipping a switch and, openly talking about, the reality of a recession that they're choosing to create to ease inflation. And I think the real risk is going to be throughout COVID, we saw all that consumption, all that demand that was pulled forward, and it really leaves a void into the future, and a void that's faced with higher borrowing costs, a higher cost of living. It's not a good recipe for economic growth. I was listening to an interview with Stan Druckenmiller last month, who's billionaire investor, one of the brightest financial market forecasters of the last few decades, talk about the U.S. Fed, and really this applies to Canada's central bank as well. He likened them to a kid driving a Porsche 200 miles an hour and not just easing his foot off the gas, but slamming on the brakes. And that's really what we saw this year. Tons of cracks starting to form around the world in the last month. I mean, the UK pension system nearly blow up. Tons of problems in Europe. Credit Suisse, same thing. Almost went belly up. The US dollar is on a wrecking path, and it's not good for the world. The reality of a soft landing is looking very unlikely. And again, they're kind of open about that. In the press conference following this morning's rate announcement, Tiff Macklem's talking about basically growth close to zero, which is a nice way of saying a recession. We'll see what happens. Inflation came in above expectations on the last reading. So that wasn't good, but it's still trending down. Inflation does, it peaked in the summer. It will continue to come down throughout this year and into next. By the bank's own forecast, they don't expect inflation to be down to 2% until 2024. But they've also stated a number of times and ended their release this morning that they're not going to stop taking action until they've achieved that 2% target. So what are we to read from that? Okay, it's not going to be until 2024. Does that mean that, they're going to continue raising rates throughout all of next year? We don't know. The reality is we really don't know. But again, the fact that we didn't get 75 basis points today was certainly a positive move. I mean, for me, it comes down to this. Can you envision the Bank of Canada continuing to raise rates as economic data continues to deteriorate? And I mean, even in the last month, we've started to see some political backlash towards the Bank of Canada for what's happened. And, I think that's certainly warranted. Again, we really don't know what to expect, but I think intuitively it seems unnecessary, and it's a tough one to, envision happening. But again, we will have to wait and see. There's at least one more rate hike being priced into the December meeting coming up. If you're in a variable rate mortgage, though, I think, until rates do drop and we get some clarity on that front, tighten up spending, avoid major purchases, be prepared for more pain, even though today was a positive move. And, as things continue to, hopefully improve on that side, you can, it's best to prepare for the worst. If you'd like to discuss any of this, please get in touch. Obviously, really really difficult time, and I'm here to help. So feel free to get in touch. But otherwise, thanks for watching, and we'll see you at the next meeting in December.